Hello everyone, myself Deepak Gupta, and today in this session of cost accounting, where we will take up the reconciliation of profit as depicted by the cost accounts and the financial accounts maintained by a business. What we're talking about that because every business obviously has the objective to generate profits, which will be obviously through that you will create a product and that product will be sold. So we will have two activities that we will have to create the product and we will have to dispose the product. That disposal will create revenues known as sales, and that creation will create cost. And obviously the sales must be more than the cost to generate the profit. So in cost accounting, our only focus is on the product. So we focus primarily on all the expenditures which have directly been incurred, or even if they are not incurred, but they are necessary for the product to be incorporated or to be created, will be deemed as cost, and we will arrive at the cost price. And based on that cost price, we will fix the sales price, and on that basis, we will estimate the profits. So ideally, when we involve into cost accounting, then it is primarily on estimated basis, because ideally you are supposed to do the pre-costing. That is before the period start, you anticipate what will be the expenditures which will be incurred. Some of the costs such as prime cost will be as close to the actual expenditure that will be incurred. It means you will be able to anticipate the prime cost more or less equally or very closely to the actual cost that will be incurred in the period to come. But some other costs such as overheads will be added, that is absorbed to the prime cost on an estimated basis. So we in more or less likely will estimate the cost price, and on that estimated cost we fix the selling price which is used to actually sell the product. And when the period is closed, when the period is actually you have recorded the actual sales, then you measure the actual sales, that is you measure the budgeted quantity with the actual quantity sold. There may be a fluctuation in the price, so you measure the budgeted price with the actual price, and you measure the budgeted cost with the actual cost, and then you always try to match the anticipated profits with the actual profits, which we will discuss in the next session. That is the profit variance or the sales margin variance. But staying on the topic for the day, that is this profit which will be anticipated as per cost accounts, whether it is the anticipated profits or whether it is the actual profits, will only be focusing on the product, and hence this profit shall be the excess of sales over the cost. But in addition to the product, the business also carries certain other activities. For example, to create the business, to make the business operational, you need certain funding. So those funding costs will be there. So those funding activities, those investment activities will be there. The form of the business will be there, the legal expenditures will be there. So there are kind of various kind of expenditures and the revenues will be there, which has nothing to do with the product directly, but which are in a way part of the business as a whole. So there may be other revenues than the sales, and there may be other expenditures than the cost. And therefore, this other activities and the product activities will totally constitute the product, sorry, the P&L account. So business performs the financial accounting activities where it creates a profit and loss account, keeping into mind both the product and the non-product activities. And we can say that the productive revenues and the non-productive revenues are matched, again the productive cost and the non-productive cost, and then we arrive at the figure of the profit and loss. So because both the cost accounting and the financial accounting have different objectives, and therefore different amounts of credits and debits are there in different accounts, therefore the profit as per the cost account, the profit as per cost account may not tally and normally does not tally with the profit as per financial account. So some companies try to match these dissimilarities and they try to make integrated accounts by operating a special accounting procedure. But most of the companies maintain cost accounts and financial accounts separately. That what we call the non-integrated accounts. And these separate non-integrated accounts obviously will give the profit as per cost accounts, and the financial accounts profit will be separate and they may not be equal. But they both belong to the same entity. And no profit is wrong because they are just different because of the different principles which have been used to calculate them. So we have to make a reconciliation statement, and this reconciliation statement is just a summary of the reasons which justifies why the profit of the cost accounts and financial accounts is not same or why they are different. So we have to first understand the reasons of the difference which are a part of this reconciliation statement, and then we have to prepare this reconciliation statement. So we will first focus on the reasons and then we will try to make the prepare or make the reconciliation statement. So this session will primarily be more focused on the reasons, and then in the sessions to come most probably we will do the preparation in a prototype manner and then through a question. So the first and foremost reason is that when we talk of the word cost, then cost is actually not equal to expense. Some people may believe that cost and expense are the one and the same thing, or some people can say that all costs are expenses but expenses are not costs and vice versa. But actually neither all costs are expenses nor all expenses are costs. For example, if I move with the definition, then cost is something which is requisite for a product to come into existence, or from the stage of acquiring the raw material to the stage of delivery of finished goods to the customer. So I'm saying from the stage of acquiring the raw material from the मार्केट से खरीदने से लेकर फिनिश गुड्स को कस्टमर तक पहुंचने तक के सारे खर्चे वो कॉस्ट है, irrespective of the fact whether they are paid or not. तो अगर मार्केट से खरीदने में कुछ खर्चा हुआ जिसे हम लोग बोलते हैं ऑर्डरिंग कॉस्ट या वेस्टेज हुई, तो वो भी कॉस्ट है, और फिनिश गुड्स को कस्टमर तक पहुंचाने में अगर कोई डिस्ट्रीब्यूशन कॉस्ट हुआ, कोई वेस्टेज हुई, तो वो भी कॉस्ट है। और इस कॉस्ट के अंदर उनका रिलेशनशिप प्रोडक्ट के साथ डायरेक्ट भी हो सकता है जैसे कि रॉ मटेरियल, और इनडायरेक्ट भी हो सकता है जैसे कि डिलीवरी बॉय का सैलरी। और ये जो दोनों के दोनों कॉस्ट हैं, चाहे वो डायरेक्ट हो चाहे वो इनडायरेक्ट हो, दे मे बी समटाइम्स पेड और समटाइम्स we use the word opportunity cost. For example, if the management is performed by an outside director, then he is paid salary, and that salary paid will constitute a kind of indirect cost known as overhead. But if the owner himself undertakes the responsibility of the company's management, then being a owner, he is actually not drawing any salary, or in a proprietorship, he is not allowed to draw a salary. So, in that case, even though the work is performed, but no salary is being withdrawn. So, there is no payment, but still, that value of the services of the owner will be deemed as the opportunity cost. Similarly, if we have taken a premises on the rent for the production services, then the rent paid is will be a cost. But if the owner is using his own premises for the production services, then obviously no rent is paid, but still the rent denotes the value of the premises which are part or parcel of the product to be manufactured. And therefore, this rent, irrespective of the fact whether it is paid or not, will always be deemed as cost. So we can always say that the items like opportunity cost are cost, but obviously they are not an expenses. Similarly, if I pay that I have taken a loan for the business activities, and on this loan the company or business is paying interest. So we say that this interest paid on such loan is industry specific, because people with high leverage, that is high debt, will pay high interest. People with low leverage, that is low loan, will pay low interest. And an all equity firm with no loan will not pay any kind of interest. So this interest payment is actually company business specific, company specific, and hence it has no relation whether directly or indirectly with the product. So we say that this interest may have a time value or may have an industry value, but has no product value, and therefore it is not treated as a cost. So being an expense still does not constitute it as a cost. So we can always say that because in the cost accounting only costs are included, and in the financial accounting all expenses are included, it means whether it is paid or whether it is due, it will be deemed as expense, but no opportunity cost will be included. So we come to two major things, that purely financial nature items, whether they are of expense character or whether they are of revenue character, are not included in cost accounts, and hence they will be a cause of reconciliation. And purely opportunity cost items, they will not be included, they will not be included in financial account, and therefore there will be various items which will either be debited or credited in the P&L account to calculate the profits, or which will be a part of the cost sheet to calculate the profit of the business through the statement of profit, and that is why those two profits may not tally. So this will constitute, I should say, the first primary reason. I will use the word R1, that is the reason 1. Now coming on to the second reason, I will use this space R2, is I will try to discuss the most prevalent and most important reasons. So the second will be the overheads, commonly known as the indirect costs. So their role in such relation, sorry, in such reconciliation process will be similar irrespective of the fact that whether they are factory overheads or whether they are office overheads or whether they are selling and distribution overheads. So just a moment. Hmm. So what the point is that in cost accounts, overheads are added. So we use the word absorbed to the prime cost on the basis of a predetermined rate. And that rate is known as overhead absorption rate, and we have discussed them in our earlier sessions. On We have a special session by the name of absorption of overheads, and you can always log into the channel and you can always check there. So this absorption rate is used for adding the amount of overheads to the prime cost and to arrive at the figure of total cost. So what will happen, that you will add direct material, add direct labor to the material, you will add direct expenses and you will arrive at the figure of prime cost. You will absorb factory overheads on one of the methods, whether they are traditional methods or activity based costing methods, as discussed earlier, to arrive at the figure of factory cost. Then you will absorb administrative overheads, ideally as a percentage of factory cost, to arrive at the figure of cost of production. And then you will add selling and distribution overheads, either as a percentage of cost of production or on the basis of units sold, to arrive at the total cost or the cost of sales. And then the total revenue from sales में से अगर आप cost of sales को minus कर देंगे, then you arrive at the figure of net profit. So this figure of profit is hugely dependent upon the overheads which have been absorbed, and that absorption has been done on the predetermined basis, which is normally dependent upon the budgeted amount of overheads and the budgeted output. And this output or the overhead may obviously vary with the period, and therefore these actual figures may be different from what have been absorbed till now. Now, when we come to the financial accounts, so the basic difference between financial accounts and cost accounts is that normally cost accounts are pre-period, that it is done before the period starts, because we should know the cost in the beginning so that we can sell the product actually. But financial account is the calculation of the profit and loss account for the period gone by. That is, financial accounts takes into account the actual figures. So they take into account the actual figures because it is post period, and cost accounts is primarily pre period. It is normally pre period. So what is happening here कि ये जो फाइनेंशियल अकाउंट्स की एक्चुअल फिगर्स हैं, यहाँ पर जब हम ओवरहेड्स की बात करेंगे तो वो ओवरहेड्स चाहे फैक्ट्री ओवरहेड्स हो, चाहे एडमिनिस्ट्रेटिव ओवरहेड्स हो, चाहे सेलिंग ओवरहेड्स हो, they will be all actual amounts. And it can happen that the overheads absorbed can either be more than actual amount, or the overheads absorbed can either be less than actual amount, or in special cases they may be equal. So in both the cases, because the overheads will be different, there will be profit difference which will justify the reasons for reconciliation. So in this case where overheads absorbed were more than the actual amount, we use the word over absorption. And here where overheads absorbed are less than the actual amount are known as under absorption. So these over absorption and under absorption of overheads are a part of reconciliation state, are a part of reconciliation state. ठीक है? And for the day we will take up the third most important reason, that will be the valuation of closing stock. And you have to watch that this closing stock can either be of the raw material, it can be of the work in progress, and it can be of the finished goods. And the reason to cover them for the reconciliation is, first of all, the method of stock valuation. Because when we come to the financial accounts, normally accounting standards and standard accounting policies are used, and therefore, ideally, FIFO is used for stock valuation. But as per cost accounts, any method is usable. So, this difference in the method of stock valuation leads in different values, and once there is a difference in the method of valuation, it will not just affect the closing stock, it will also affect the opening stock of the next period, because closing stock of one period will become the opening stock of the next period. So once this difference starts, it implicates the difference in two consecutive periods. So even a difference, or even the method difference of 1 year will affect the profitability reconciliation statement for the 2 years, that is the current year and well as the consecutive year. So one is reason is the method of stock valuation, and the second reason can be, for example, that we should first consider the finished goods stock valuation, because that is where the primary value rises. That when we take the cost accounts, the closing stock of finished goods is valued at cost of production, that is office cost. It means in cost accounts, office cost is also included to value or to arrive at the closing stock valuation of the finished goods. But when we take the financial accounts, here the closing stock of finished goods is valued at factory cost. एंड फैक्ट्री कॉस्ट का मतलब बेसिकली क्या हुआ कि आपने कॉस्ट ऑफ प्रोडक्शन में से एडमिनिस्ट्रेटिव ओवरहेड्स हटा दिए, तभी फैक्ट्री कॉस्ट आई. तो वी कैन से कि क्लोजिंग स्टॉक फिनिश गुड्स का फाइनेंशियल अकाउंट्स में कॉस्ट अकाउंट्स के मुकाबले अंडर वैल्यूड है. मैंने वो फिगर प्रॉफिट के हिसाब से लगाई, तो यहाँ क्लोजिंग स्टॉक अंडर वैल्यूड है, और क्लोजिंग स्टॉक अंडर वैल्यू होने के चक्कर में जो प्रॉफिट है वो कॉस्ट, यहाँ वैल्यू कम होने के चक्कर में जो यहाँ का प्रॉफिट है वो कॉस्ट अकाउंट्स के मुकाबले कम हो जाता है. तो एक ही स्टॉक अलग अलग अकाउंट्स में अलग अलग वैल्यूएशन के चक्कर में अफेक्ट द प्रॉफिट्स डायरेक्शनली. तो अगर क्लोजिंग स्टॉक क्योंकि क्रेडिट साइड में आता है, और या ये कहिए कि कॉस्ट को कम करके प्रॉफिट को बढ़ाता है, तो अगर ये स्टॉक की वैल्यूएशन कम हुई तो कॉस्ट अकाउंट्स का प्रॉफिट फाइनेंशियल के मुकाबले ज़्यादा होता है. और अगर ये फिगर क्लोजिंग स्टॉक की नेक्स्ट ईयर ओपनिंग स्टॉक बन गई तो इट मेक्स एन इम्पैक्ट एडवर्सली. So in addition to the other various reasons, these three are the primary reasons, and we will discuss certain more reasons in the sessions to come. But we can say the reconciliation is not a summary of the errors, but it is a summary of the reasons due to which the profit of the same business, but due to different principles of accounting used in cost accounting and financial accounting, the profit is justified to show that both the profits are same within their agreed principles. Thank you very much, Deepak Gupta, writing.